Welcome everyone. In this course, we're going to make insurance simple, practical, and useful. By the end, you'll understand how risk is shared, how the main classes of business fit together, and why insurance keeps economies moving. Let's get started. 1. Introduction to insurance and risk. Insurance exists because the future is uncertain. No one can predict exactly when accidents, losses, or disasters will strike, but we can prepare for them financially. At its core, insurance is a simple promise. A group of people or organizations each contribute a small, regular payment so that anyone who suffers a major loss can receive help when they need it most. It's a community-based solution to individual uncertainty. 1.1. Why risk matters. Every activity in life carries some level of risk: driving to work, running a business, or sending a shipment across the world. Some of those risks are minor. Others could cause severe financial or emotional damage. Insurance does not remove risk. It redistributes it. By pooling contributions from many policyholders, the insurer can compensate the unlucky few who actually experience losses. This collective sharing makes economic life more stable and predictable. 1.2. The purpose of classification. Because insurance can cover almost anything: lives, property, vehicles, aircraft, satellites, and even digital information, the industry must organize itself into clear categories called classes of business. Classification makes it possible to match specialized knowledge to the correct type of risk, apply accurate pricing and reserving methods, ensure regulatory compliance and capital management, develop efficient claims handling processes. Without such structure, the insurance world would be impossible to manage. 1.3. Traditional ways to classify insurance. Historically, insurers have grouped business in several ways: life versus non-life or general insurance. Life insurance focuses on human life, providing money to dependents or financial security after death or disability. Non-life insurance covers physical property, liability, and short-term risks such as fires, car accidents, or theft. Short-tail versus long-tail business. Short-tail classes like motor or property produce claims and settlements quickly, making losses easier to estimate. Long-tail classes like liability or professional indemnity may take years to settle, so insurers must estimate future payouts carefully. Marine versus non-marine. Marine insurance, the earliest form of organized cover, dealt with ships and cargoes. Non-marine later expanded to include almost everything else: buildings, people, and modern industries. 1.4. How classes define the industry. Every insurer builds its operations around these categories. Each class has its own underwriters, actuaries, and claims experts, all relying on different data and analytical models. For example, a property underwriter studies construction materials and fire exposure. A life underwriter analyzes age and health statistics. A marine specialist tracks shipping routes and vessel types. Clear division allows focus and accuracy, essential for long-term profitability and solvency. 1.5. The evolution of insurance classes. The classification of insurance has grown in parallel with human progress. In the 16th and 17th centuries, marine trade dominated, giving birth to formal marine policies. The 18th century saw the rise of fire and early life insurance. The 19th century brought industrialization, workplace liability, and accident cover. The 20th century added motor, aviation, and reinsurance. The 21st century introduced cyber, renewable energy, and event-related risks. Each era created new exposures, and insurers adapted accordingly. 1.6. The modern framework. Today, nearly every global insurer recognizes the following broad divisions of business: non-marine property and casualty, marine and energy, motor, aviation and space, life and personal accident, financial or pecuniary lines, emerging and specialized classes, reinsurance supporting all other lines, Each division demands unique expertise, policy language, and regulatory oversight. 1.7. Why understanding classes is important. Knowing how insurance is structured helps anyone entering the industry, from analysts to brokers to underwriters, understand the big picture. When you can identify a class of business, you instantly know the type of risk being insured, the likely policy duration and claims pattern, the specialists and data involved in underwriting it. In short, the concept of classification is the foundation on which all other insurance knowledge rests. 2. Non-marine property and casualty. Insurance began with ships and trade routes, but today the majority of the world's insurance premiums come from land-based risks, homes, factories, offices, vehicles, and the legal liabilities that come with modern life. This broad area is called non-marine insurance, and within it lie two powerful pillars: property insurance and casualty liability insurance. 2.1. The scope of non-marine insurance. Non-marine business protects almost everything that exists on land: buildings, stock, machinery, income, and legal responsibilities. It also covers construction projects, theft, and business interruption after an accident. Because it touches almost every business and household, non-marine insurance is often described as the backbone of general insurance. A single manufacturing company might hold 5 or 6 policies under this umbrella, covering fire, theft, breakdown, employer's liability, and even loss of profits. 2.2. Property insurance, protecting tangible assets. Property insurance deals with the physical world, things you can see, touch, and value. Whether it's a factory, a retail store, or an apartment block, the goal is simple: return the policyholder to the same financial position they enjoyed before a loss occurred. Core perils and coverage. The classic perils covered include fire and lightning, the oldest and most fundamental risks. Explosion, generally limited to boilers or domestic gas systems. Storm and flood, increasingly important due to climate change. Theft, loss of property following forcible or violent entry. Riot and civil commotion, protection from social unrest or vandalism. Policies can also extend to include earthquakes, subsidence, and impact from vehicles or aircraft. Material damage. The policy promises to repair, reinstate, or pay cash compensation for damaged property. The insured must have an insurable interest, meaning they would suffer financial loss if the item were destroyed. 2.3. Special forms of property cover. Engineering and construction risk. Modern construction sites involve dozens of contractors and millions of pounds in equipment and materials. Specialized policies handle these complex projects. Contractors All Risks CAR covers all parties involved in a building project for accidental loss or damage to works, materials, and machinery on site. Erection All Risks EAR for the installation of heavy equipment or machinery, especially industrial plants. Advanced loss of profits or delay in startup DSU compensates project owners if a delay caused by an insured event leads to loss of income. These policies ensure that construction continues even after setbacks like fire, theft, or storms. Glass and specialty covers. High-value glass fronts, decorative fixtures, and mirrors are often insured separately to ensure quick replacement and minimize exposure to theft after breakage. Livestock and bloodstock. Agricultural clients can insure valuable animals, racehorses, breeding stock, or exotic species against death, accident, disease, or loss of use. 2.4. Theft and fidelity risks. Theft insurance is narrower than many expect. Most policies require visible signs of forcible or violent entry or exit, ruling out losses by deception or insider theft. To address internal fraud, insurers offer fidelity guarantee policies, which cover an employer against theft or embezzlement by trusted staff. Today, many of these risks overlap with cybercrime, so insurers have started merging traditional fidelity protection with digital fraud cover. 2.5. Money and pecuniary insurance. Money doesn't always sit safely in a bank. It moves constantly between stores, cash offices, and armored vans. Money policies protect these funds while in transit or stored at business premises. Typically, they define money broadly to include cash, checks, stamps, vouchers, and even credit card slips. Coverage sections often distinguish between money kept in safes, money held on the premises during business hours, money carried by staff, money in transit, and money held in private residences. The policy may also provide limited cover for assault on employees during robbery. 2.6. Business interruption consequential loss. Property insurance fixes the damage, but it doesn't pay for the time a business is unable to trade. Business interruption BI cover fills the gap, protecting lost income and additional expenses after a major event such as fire or flood. To trigger a BI claim, there must usually be a valid material damage claim first. This is called the material damage proviso. Cover can extend to include losses caused by suppliers or customers affected by a disaster contingent BI, utility failures, access restrictions due to damage nearby. BI transforms physical recovery into financial survival. 2.7. Liability insurance, the casualty side. Where property insurance repairs things, casualty insurance protects people and organizations from legal claims. Liability arises whenever one person's negligence causes harm to another. Public liability protects businesses if a member of the public is injured or their property is damaged in connection with the company's operations. For example, a customer slipping in a store or a falling sign damaging a car. Products liability covers manufacturers or suppliers when a defective product causes injury or damage. This line became vital after landmark consumer protection laws made producers strictly liable, even without proven negligence. Employers' liability covers injuries or diseases suffered by employees in the course of work. In many countries, this insurance is compulsory, ensuring workers receive compensation without lengthy legal battles. Professional indemnity, also known as errors and omissions or malpractice insurance, it protects professionals, from doctors to architects, against claims of negligence, error, or omission in their advice or service. Directors and officers D&O safeguards senior executives from claims alleging mismanagement or breach of duty. Although often linked to corporate governance, it remains part of the wider casualty family. 2.8. How liability works. To succeed in a liability claim, the injured party must usually prove the duty of care existed. The duty was breached through negligence or failure to act reasonably. The breach caused actual damage that was foreseeable. Insurance steps in to fund legal defense and pay damages, protecting both the business and the injured third party. Most policies also cover legal costs in addition to compensation, subject to the insurer's consent. 2.9. The role of law and regulation. Modern liability insurance is shaped by legislation such as health and safety rules, environmental protection acts, and product safety regulations. These laws raise standards for employers and manufacturers, making liability policies indispensable for compliance and financial protection. 2.10. Why non-marine property and casualty matter. Non-marine insurance touches almost every individual and business on the planet. It ensures homes can be rebuilt after a fire, employees are compensated for workplace injuries, and companies survive disasters that might otherwise bankrupt them. Without it, daily commerce and industry would grind to a halt. This class of insurance represents the foundation of general insurance, providing stability for both people and economies. Now that we've explored how insurers protect assets and legal responsibilities on land, it's time to move offshore to the origins of the insurance world. In Section 3, we'll explore marine and energy insurance, where the story of insurance truly began. 3. Marine and energy insurance. If we trace insurance back to its roots, it leads us to the sea. Long before we insured cars, planes, or data, merchants were insuring ships and cargoes, the lifelines of global trade. Marine insurance is not just another class of business. It's the foundation of the entire insurance industry. And as technology evolved, so did its reach, expanding from wooden vessels to oil rigs, offshore platforms, and now renewable energy infrastructure. 3.1 Origins and Evolution. In the early days of sea trade, merchants pooled funds to compensate anyone whose ship or cargo was lost to storms or piracy. By the 16th century, marine insurance had become an established practice, so widespread that a formal system was needed to handle disputes and set standards. The creation of organized insurance chambers and standardized policy wordings in the 1700s laid the foundation for today's marine market. From those beginnings, marine insurance evolved into a sophisticated global network capable of covering everything from fishing boats to supertankers. 3.2 What marine insurance covers. Marine insurance protects against the hazards of navigation, both at sea and along inland waterways. It covers not only the ship itself, but also the cargo it carries, the crew's liabilities, and even the loss of income when operations are interrupted. The class can be broadly divided into four main components. Hull and machinery H&M, damage to the vessel itself. Cargo insurance, protection for goods in transit. Loss of earnings or loss of hire, income lost when a vessel cannot operate. Protection and indemnity P&I, third-party liabilities. Each of these elements has its own unique policy wording, rating structure, and exclusions. 3.3 Hull insurance, protecting the vessel. Hull insurance is the marine equivalent of motor insurance for ships. It covers accidental physical loss or damage to the vessel's hull, engines, and machinery caused by a range of perils such as collisions, groundings, or striking submerged objects, fire and explosion, violent theft or piracy, natural disasters such as earthquakes or lightning, jettisoning cargo to save the ship, accidents during loading, unloading, or refueling. The policy often also includes coverage for liabilities arising from collisions, though traditionally only 75% of this cost is covered. The remaining 25% is usually insured separately through a protection and indemnity club P&I, a cooperative mutual insurer formed by shipowners. 3.4 Typical exclusions and optional add-ons. Marine policies exclude certain high-level or political risks that would be difficult to price fairly, such as war or hostile acts, terrorism and piracy in war zones, strikes or malicious acts, nuclear or radioactive contamination. However, insurers often allow these perils to be bought back under separate war risk or terrorism extensions. Merchant ships entering conflict-prone waters, for example, can purchase temporary coverage while transiting risky regions. 3.5 Ships under construction. Even before a ship sets sail, it faces risks. Builders' risk insurance or vessels under construction cover protects shipbuilders and owners during the construction phase and sea trials. As the vessel nears completion, its value rises, and the policy automatically adjusts the insured amount to reflect that growth. Coverage includes fire, explosion, collision, and sometimes latent defects that appear during testing. Once delivered, the new owner arranges standard operational marine insurance. 3.6 Cargo insurance, protecting goods in transit. Cargo insurance protects goods being shipped by sea, air, road, or rail. The policy wording most widely used worldwide is based on the Institute Cargo Clauses ICC, which come in 3 levels. ICC Air, All Risks Comprehensive Protection. ICCB, named perils such as fire, collision, or stranding. ICCC, basic cover with fewer insured events. Common exclusions include inherent vice goods that spoil naturally, poor packaging, delay, willful misconduct, and unseaworthiness of the vessel. Example scenario: company shipping electronics from Singapore to Europe might choose ICCA for full protection against loss or damage at any point in the journey, from warehouse to warehouse. 3.7. The principle of general average. General average is a centuries-old maritime law principle that says, if part of a ship or its cargo is deliberately sacrificed to save the rest, everyone shares the cost. For example, if cargo is jettisoned during a storm to lighten the ship and prevent sinking, every cargo owner on board contributes proportionally to the loss, even those whose goods arrived safely. This principle promotes fairness and mutual responsibility among all parties in a voyage. 3.8. Specialist marine covers. Beyond traditional ships and cargo, marine insurers handle a variety of specialized risks, including jeweler's block, high-value gems and precious metals held or transported by jewelers, fine art, artwork in transit or on display at galleries and exhibitions, cash in transit, physical money or valuables moved by security firms, political risk, protection against government confiscation, expropriation, or political violence. These policies often merge elements of marine, property, and political risk insurance, requiring experienced underwriters and bespoke terms. 3.9. The rise of energy insurance. As technology advanced, insurers extended marine principles to the rapidly expanding energy sector. Originally, energy meant hydrocarbon exploration, oil and gas drilling at sea. Today, it includes both offshore and onshore facilities, covering platforms, pipelines, refineries, and renewable installations like offshore wind farms. Energy insurance deals with massive, complex assets exposed to physical, operational, and environmental risks. Policies are highly customized because a single project can involve billions of dollars in investment. 3.10. Offshore energy risks. Offshore operations take place in some of the harshest environments on Earth: deep waters, strong winds, and remote conditions. The key coverages include damage during rig construction or installation, blowouts or well control incidents, pollution liability and cleanup, removal of debris after accidents, re-drilling and business interruption losses. The insurer's goal is to restore the insured company to the financial position it held before the loss, a principle central to all forms of insurance. 3.11. Onshore energy and renewables. While offshore energy remains significant, modern insurers now focus increasingly on renewable sources such as offshore wind turbines and subsea cables, solar farms and hydrogen production plants, carbon capture and storage projects. These new industries require fresh risk models and technical understanding. Although they share engineering principles with oil and gas, their risk patterns, especially environmental and supply chain related, differ dramatically. 3.12. The connection between marine and energy. Marine and energy insurance share the same DNA. Both involve high-value physical assets, complex logistics, and exposure to natural and man-made hazards. Both depend heavily on engineering expertise, safety protocols, and reinsurance support, and both reflect the same underlying principle that has defined insurance for centuries: to help people take risks safely. 3.13. Why marine and energy still matter. Even in the digital age, 90% of the world's trade still moves by sea, and global energy demand continues to grow. From container ships to wind farms, this class of insurance enables international commerce, industrial growth, and global connectivity. Without marine and energy insurance, ships wouldn't sail, ports wouldn't function, and much of the world's power infrastructure couldn't operate. Now that we've navigated the seas and explored offshore operations, we move back to land, to one of the most familiar forms of insurance that touches almost everyone's life: motor insurance. In this section 4, we'll explore how vehicles, liability, and legislation combine to create one of the most visible and tightly regulated branches of insurance. 4. Motor insurance. If marine insurance protected the world's ships, then motor insurance became its land-based equivalent. As cars and commercial vehicles transformed society, they introduced an entirely new set of risks: collisions, injuries, theft, and property damage. Today, motor insurance is one of the most recognized and widely purchased types of insurance worldwide. Almost every driver, delivery company, and transport operator depends on it to stay legally compliant and financially secure. 4.1. The origins of motor insurance. The first car insurance policies appeared at the turn of the 20th century, when motor vehicles were still a luxury for the wealthy. At that time, accidents involving pedestrians or property quickly revealed the need for a financial safety net. As car ownership grew, most countries introduced laws making third-party liability insurance compulsory, ensuring victims of accidents could be compensated even if the driver couldn't afford it. In the UK, this requirement became law through the Road Traffic Act 1930, later expanded under the Road Traffic Act 1988, which remains the foundation of motor insurance legislation today. 4.2. The purpose of motor insurance. Motor insurance is designed to protect drivers against the cost of repairing or replacing their own vehicle, cover legal liability for injury or damage to other people or property, provide financial support to victims of road accidents. Every policy reflects a balance between personal protection and social responsibility, ensuring roads remain safe and fair for everyone. 4.3. Types of motor insurance coverage. Motor insurance can be categorized into several key types, each addressing a different level of protection. 1. Third-party only TPO, the most basic and legally required form. It covers injury or death to others, damage to other people's property. It does not cover damage to the insured's own vehicle. This is the minimum level required by law for vehicles operating on public roads. 2. Third-party fire and theft TPFT. In addition to third-party cover, this policy also protects the insured's vehicle against fire damage, theft, or attempted theft. It's often chosen by owners of mid-range or older cars where full comprehensive cover isn't cost-effective. 3. Comprehensive, the broadest level of protection, covering all third-party liabilities, accidental damage to the insured's own vehicle, fire, theft, and vandalism, personal injury to the driver in many cases, optional extras such as windscreen repair, courtesy car, or breakdown assistance. Comprehensive cover is the most popular among private motorists and companies managing vehicle fleets. 4.4. Types of vehicles covered. Motor insurance doesn't just apply to private cars. It extends across a wide range of vehicles, including commercial vehicles, vans, trucks, tankers, delivery fleets, public service vehicles, buses, taxis, minibuses, agricultural and forestry vehicles, tractors, harvesters, specialist vehicles, construction equipment, cranes, forklifts. Each type of vehicle presents a distinct risk profile. For example, a delivery van may face exposure to traffic accidents and theft, while an agricultural vehicle faces damage risks on private land, but lower third-party exposure. 4.5. Motor fleet and trade policies. Instead of insuring each vehicle separately, many companies use fleet insurance, a single policy covering all vehicles owned or operated by the business. Fleet policies simplify administration, reduce costs, and allow better risk management through loss records and driver training. Motor trade policies are designed for businesses that handle other people's vehicles, such as garages, dealers, and repair shops. They cover vehicles under the trader's custody or control, whether for repair, testing, or sale. 4.6. Key policy features. Every motor policy includes important standard conditions. Permitted use. Defines who can drive and for what purpose: social, business, hire, and reward. Territorial limits. Usually covers driving within specific countries or regions. Overseas use may require an extension. Excess, the portion of each claim paid by the insured. No claims discount, a reward for claim-free years that reduces future premiums. Policy limits, specifies maximum amounts payable for property damage or bodily injury. Most modern policies also provide personal accident benefits, medical expenses, and legal assistance for accident-related claims. 4.7. Rating factors and premium calculation. Motor premiums are calculated using a combination of factors including driver's age, experience, and claims history, vehicle type, value, and engine size. Location: urban areas tend to have more theft and collision risk. Usage pattern: personal, commuting, delivery, or hire. Annual mileage and storage: location, garage, or street. Advanced insurers now use telematics, small devices, or mobile apps that monitor driving behavior, allowing safer drivers to earn lower premiums through data-driven pricing. 4.8. The role of law and regulation. Motor insurance is one of the most tightly regulated forms of insurance. Legislation ensures all vehicles used on public roads have at least third-party cover. Victims of uninsured or hit-and-run drivers can receive compensation through guarantee funds. Policyholders can trace an insurer responsible for a specific vehicle through registration databases. These measures protect both motorists and the public, maintaining trust in the system. 4.9. Common exclusions. While policies are broad, certain exclusions apply. Driving without a valid license or under the influence of drugs or alcohol. Using the vehicle for purposes not permitted, for example, racing. Wear and tear or mechanical failure. Theft resulting from carelessness, keys left in ignition. Understanding exclusions is critical for preventing claim disputes. 4.10. Claims and settlement. When an accident occurs, the process usually follows these steps. Notification. The insured reports the event as soon as possible. Assessment. Insurers verify fault, damage, and policy coverage. Repair or replacement. Approved repairers fix the vehicle or a total loss settlement is offered. Third-party handling. Liability to others is negotiated and settled, including injury claims. Modern systems now use AI to automate minor claims, reducing turnaround times dramatically. 4.11. The importance of motor insurance. Motor insurance is more than a legal formality. It's a key mechanism for public protection. Without it, victims of road accidents might never receive compensation, and drivers would face financial ruin for even a small mistake. It also plays a crucial economic role, keeping transportation industries operational, supporting repair services and supply chains, providing data for road safety improvements. From the roads, we now take to the skies. In the next section 5, we'll explore aviation and space insurance, where risk management meets some of the most advanced technology ever built by humankind. 5. Aviation and space insurance. If marine insurance was born from the sea, aviation insurance was born from humanity's dream to conquer the skies. When the Wright brothers flew their first aircraft in 1903, nobody imagined that within a few decades, planes would carry millions of passengers and cargo around the globe, or that entire industries would rise to protect those flights from financial loss. Aviation insurance represents one of the most specialized, technical, and globally coordinated areas of the insurance market. It deals with complex machinery, strict regulation, and the safety of human lives, all within a high-value, high-risk environment. Closely connected to aviation is another remarkable class of business, space insurance, which covers the rockets and satellites that operate far beyond Earth. 5.1. The origins of aviation insurance. The first aviation policy was issued in 1911, only 8 years after the first powered flight. At the time, aircraft were fragile, experimental, and extremely risky to insure. By the mid-20th century, commercial air travel had become routine, and the need for structured aviation insurance expanded rapidly. Today, aviation insurance supports everything from private gliders and helicopters to large passenger jets, airports, and even space vehicles. 5.2. The scope of aviation insurance. Aviation insurance covers both physical damage, property, and liability associated with aircraft operations. Broadly, it can be divided into aircraft hull insurance, damage to the aircraft itself; aviation liability insurance, compensation for injury or damage to others; specialized covers, airports, maintenance facilities, pilots, and space equipment. 5.3. Hull and machinery insurance. Hull insurance protects aircraft from accidental damage or total loss. This includes private planes, airliners, helicopters, and even hot air balloons. Common causes of loss include collisions during takeoff or landing, bird strikes, storms, lightning or hail, fire or explosion on the ground or in flight, theft, vandalism, or sabotage. Aircraft are extremely expensive. A modern jet can cost hundreds of millions of dollars, so even small damages can trigger substantial claims. Policies may be written on an all-risks basis covering most accidental causes, or a ground risks-only basis for aircraft that are parked, stored, or under repair. 5.4. Aviation liability insurance. Where hull insurance covers the plane itself, aviation liability insurance protects against claims from third parties, passengers, and crew. Main areas of liability: passenger liability, injury or death of passengers while boarding, flying, or disembarking; third-party liability, damage to people or property on the ground, such as airport workers or buildings; products liability, covers manufacturers and maintenance providers if a defect or repair fault causes an accident; cargo liability, covers damage to goods transported by air. Because aircraft incidents often involve multiple jurisdictions and high compensation amounts, these claims can reach into the tens or hundreds of millions. 5.5. Legal frameworks and international conventions. Aviation insurance operates under strict international law. The Montreal Convention 1999 governs passenger rights and airline liability for injury, death, and baggage loss. Under this convention, airlines are strictly liable for proven damages up to a fixed threshold measured in special drawing rights, an international currency unit. Beyond that limit, airlines can defend themselves only by proving they were not negligent or that a third party was responsible. This system ensures that passengers and their families receive fair compensation while maintaining accountability for airlines. 5.6. Loss of license and loss of use. A unique feature of aviation insurance is loss of license cover. If a pilot or air traffic controller becomes medically unfit to work, their professional license may be suspended. This policy provides financial support during the period they are unable to fly or control traffic, protecting their livelihood. Similarly, loss of use insurance covers airlines if an aircraft is damaged and temporarily grounded, compensating for lost income while repairs are underway. 5.7. Airport and ground operations. Airports are vast ecosystems filled with risks unrelated to flight itself. Specialized covers protect airport operators against liability for accidents on their premises, hangar keepers for damage to aircraft under repair or storage, ground handlers and fuel suppliers for injury or property damage caused by their operations, catering and maintenance companies for contamination or service-related accidents. These policies ensure the aviation industry functions smoothly from runway to terminal. 5.8. War and terrorism risks. Because aircraft are valuable, visible targets, insurers often exclude war-related perils from standard policies. However, war risk insurance can be purchased separately to cover hijacking or sabotage, war or civil unrest, confiscation or seizure by governments, terrorism-related incidents. Such cover is vital for airlines operating in politically unstable regions. 5.9. Space insurance, extending risk beyond Earth. When humans ventured beyond the atmosphere, insurers followed. The first space policy was written in 1965, covering the launch and operation of satellites. Space insurance deals with extremely expensive assets that are impossible to repair once deployed. It typically includes launch insurance, covers total or partial failure during liftoff. In-orbit insurance, protects against malfunction or collision in space. Third-party liability, covers damage caused by debris or falling objects. Claims can arise if a satellite fails to reach orbit, stops transmitting, or becomes uncontrollable. Because satellites are valued in the hundreds of millions, and their revenue streams depend on years of uninterrupted service, even partial losses are significant. 5.10. Underwriting challenges. Aviation and space insurers face unique challenges. Low frequency, high severity, accidents are rare, but when they occur, they are catastrophic. Complex engineering requires deep technical knowledge of engines, electronics, and design. Global exposure. One aircraft may fly across dozens of jurisdictions in a single day. Rapid innovation. Drones, electric aircraft, and reusable rockets are constantly changing the risk landscape. Underwriters must therefore combine engineering expertise with data-driven risk modeling and strong reinsurance support. 5.11. Why aviation and space insurance matter. Without aviation insurance, airlines couldn't operate, airports couldn't function, and global tourism and trade would collapse. Without space insurance, we'd risk losing communication, navigation, and weather satellites that power a modern world. This class of insurance enables exploration, transportation, and global connectivity from the skies above to the edges of outer space. Next, we shift from machines and infrastructure to the most human of all risks, life itself. In Section 6, we'll explore life assurance and personal accident insurance, where the value insured is not a ship, a building, or a plane, but the person behind it all. 6. Life assurance and personal accident insurance. While most insurance protects physical assets, ships, cars, buildings, the oldest and most personal form of cover is life assurance. It exists to protect what matters most: the people themselves. When someone dies, becomes seriously ill, or suffers a disabling accident, the financial consequences can be devastating for their family or dependents. Life and personal accident insurance step in to provide stability when life's most difficult moments occur. 6.1. The purpose of life assurance. Life assurance or life insurance pays a predetermined sum of money when the insured person dies or suffers a critical illness, depending on the policy type. Unlike most other insurance classes, it doesn't aim to restore property. It provides a financial benefit to ease loss or hardship. It gives families the ability to continue their lifestyle, pay off debts, or secure children's education. For businesses, it protects against the loss of a key employee or partner. Life assurance is therefore not just a financial product, it's an act of responsibility and care. 6.2. Benefit policies versus indemnity policies. Most non-life insurance aims to indemnify, to put the policyholder back in the same financial position as before the loss. Life assurance works differently. It's a benefit policy. It pays a fixed amount, known as the sum assured, based on the policy agreement, not the financial value of the person's life. For example, a £200,000 life policy will pay £200,000 on death, regardless of the deceased's income or debts. This simplicity makes life assurance one of the most predictable and emotionally reassuring forms of insurance. 6.3. Insurable interest and policy ownership. In life insurance, the principle of insurable interest means you can only insure a life if you would suffer a genuine loss from that person's death. For instance, you can insure your own life. A spouse or partner can insure each other. A company can insure a key employee or director. Once the policy is taken out, Ownership can usually be assigned or transferred to another party, for example, as loan collateral or part of an estate plan. 6.4. Major types of life policies. Life assurance comes in several forms, each designed for different needs and timeframes. 1. Whole-of-life policies. These provide lifetime protection. As long as premiums are paid, the policy remains in force, and a claim is guaranteed. The payout happens when, not if, the insured person dies. Some versions accumulate a cash value over time, allowing policyholders to withdraw or borrow against it. 2. Term assurance. Covers a specific period, for example, 10, 20, or 30 years. If the insured dies during that period, the benefit is paid. If not, the policy expires without value. Term assurance is popular for mortgage protection or family income cover because it's affordable and straightforward. 3. Endowment assurance. Combines protection and savings. It pays out either on death during the term or at maturity if the insured survives. Historically, many people used endowments to repay mortgages or save for major goals. 4. Annuities. An annuity works in reverse. Instead of paying a lump sum at death, the policyholder pays premiums to receive a guaranteed income later in life, often after retirement. It's a way to convert accumulated savings into a steady, predictable stream of income. 5. Group life and death in service benefits. Employers often provide life cover for their staff as part of a benefits package. If an employee dies while in service, the policy pays a multiple of their salary to their family. This is common in corporate and government employment structures. 6.5. Personal accident PA insurance. Personal accident insurance provides a lump sum or periodic payment if a person is injured, disabled, or killed due to an accident. Unlike life assurance, which covers death from any cause, PA focuses specifically on accidental injury or violent external events. It typically pays out for death or total permanent disability, loss of limbs, eyesight, or other major functions. Temporary total disability when someone cannot work for a period. Payments may be one-off lump sums or weekly benefits during recovery. 6.6. Sickness and illness extensions. Many PA policies can be extended to include illness or sickness cover, offering benefits if a person is unable to work due to disease rather than physical injury. Some versions even include unemployment cover, designed to maintain income stability during tough times. This type of insurance bridges the gap between life assurance long-term certainty and general insurance short-term recovery. 6.7. Kidnap and ransom K&R insurance. In regions with higher security risks, individuals and companies purchase kidnap and ransom insurance. These policies reimburse ransom payments made to secure a hostage's release and cover related costs like crisis negotiation, travel, and medical expenses. For multinational businesses, K&R coverage can extend to employees stationed abroad, business travelers and executives, family members of high-risk individuals. Although highly specialized, this type of policy is critical for global operations in unstable areas. 6.8. Tax and savings benefits. In many countries, life assurance policies come with tax advantages. Premiums may qualify for deductions, and payouts may be tax-free. This dual role, protection plus savings, makes life insurance a cornerstone of financial planning for families and individuals. 6.9. The role of life and PA insurance in society. Life and personal accident insurance play a vital role in maintaining social and economic stability. They protect families from financial collapse, support economic recovery after tragedy, encourage personal responsibility and long-term planning. For businesses, they help retain staff, manage risk exposure, and support employee welfare, a major factor in attracting talent. 6.10. Challenges and modern developments. Modern life insurers face new challenges such as changing demographics and longer life expectancy, rising healthcare costs, data privacy concerns around genetic and medical information, the need for flexible, digital products that adapt to individual lifestyles. Meanwhile, advances like wearable health devices and AI-driven underwriting are transforming how risk is measured and priced. 6.12. Why this class matters. Life and personal accident insurance remind us that not all losses are physical or financial. Some are deeply human. These products exist to help people rebuild emotionally and financially after loss or injury. They form one of the most enduring and compassionate branches of the insurance industry. Next, we'll explore insurance designed not for physical damage or human life, but for financial loss, policies that protect money itself, from theft to business interruption. In Section 7, we'll dive into financial and pecuniary insurance, where numbers, contracts, and continuity take center stage. 7. Financial and pecuniary insurance. Up to this point, we've focused on insurance that protects tangible things, ships, cars, buildings, and even people. But modern economies also depend on something less visible yet equally vital: money itself, income, profit, and the flow of financial transactions. That's where financial and pecuniary insurance comes in. It protects against economic loss rather than physical damage. These policies ensure that when business is interrupted, funds stolen, or projects delayed, companies can still meet their financial obligations. 7.1. What is pecuniary insurance? The term pecuniary simply means relating to money. This class covers losses measured purely in financial terms, for example, loss of income, additional expenses, or missing funds. It's designed to answer a fundamental question. What happens to my business if I can't earn revenue or someone interferes with my cash flow? This class is broad and flexible, often customized to suit the financial realities of different industries. 7.2. Core types of financial and pecuniary insurance. Let's explore the major forms of cover under this category. 1. Business interruption insurance, also known as consequential loss insurance. This cover supports businesses when they can't trade due to an insured event, typically fire, flood, or storm. While property insurance repairs the damage, business interruption insurance replaces the lost income and covers extra expenses needed to continue operations. Typical sections include loss of gross profit or revenue to maintain income during downtime, increased cost of working, covers temporary expenses such as renting alternative premises, extensions, supply chain interruption, denial of access, or damage at a key customer's site. Business interruption transforms short-term survival into long-term stability. 2. Money insurance. Cash remains one of the most vulnerable assets. Money insurance protects currency, checks, vouchers, or postal orders against loss while in transit, on premises, or held in safes. Policies usually distinguish between money in safes or strong rooms after business hours, money on the premises during the day, money being transported by staff or security firms, assault on employees during a robbery. The policy limit varies by location and security measures, alarms, CCTV, or armored transport, or reduce risk. 3. Fidelity guarantee employee dishonesty. Even trusted employees can commit fraud or embezzlement. Fidelity guarantee insurance covers losses caused by dishonest acts such as theft, forgery, or fraudulent transfers. It protects employers against internal crime, one of the oldest yet still most common financial threats. Today, many Fidelity policies extend to computer fraud and electronic fund transfers, bridging traditional and cyber risk. 4. Credit insurance. When businesses sell goods or services on credit, there's always a risk that customers won't pay. Trade credit insurance covers that non-payment risk due to insolvency or protracted default. It helps companies expand safely, borrow from banks using insured receivables, and maintain liquidity even when major clients fail. Credit insurers often provide risk intelligence, helping businesses identify reliable partners and monitor global economic conditions. 5. Bonds and guarantees. In major construction or service contracts, one party often requires a financial guarantee that the other will perform as promised. Surety bonds or performance bonds serve this purpose. If the contractor defaults, the insurer called the surety compensates the project owner up to the bond's value. This ensures continuity in infrastructure and engineering projects where time and trust are critical. 7.3. Construction-linked financial covers. Construction and energy projects combine physical and financial risks. Alongside contractors' all risks CAR and erection all risks EAR policies, insurers provide advanced loss of profits ALOP or delay in startup DSU cover, compensating the project owner for lost revenue if completion is delayed due to an insured event. Project guarantee policies, ensuring contractors meet their performance and payment obligations. These hybrid covers bridge engineering and financial protection. 7.4. Other specialized financial covers. Bankers' blanket bonds BBB. Comprehensive protection for banks and financial institutions, covering employee dishonesty, forgery, counterfeit currency, and securities fraud, robbery or burglary at branches, computer and electronic crime. The BBB acts as a package policy that keeps the global banking system resilient against internal and external fraud, contract frustration, and political risk, protects investors and contractors working overseas from losses caused by government actions, embargoes, currency restrictions, or political upheaval. For example, if a foreign government cancels a contract or nationalizes assets, the insurer compensates for the financial loss. Event cancellation and non-appearance, a vital policy for entertainment, sports, and conferences. It covers financial losses when events are cancelled or postponed due to weather, strikes, illness of a key performer, or unforeseen disasters. The global events industry relies heavily on this class to stay solvent after disruptions. 7.5. Common exclusions. Although broad, financial and pecuniary covers exclude normal business risks or trading losses, fluctuations in market prices or currency exchange rates, fraud by senior management unless specifically included, losses where no insurable event or negligence is proven. These exclusions maintain fairness between genuine risk transfer and normal commercial responsibility. 7. 6. How financial lines differ from other classes. Financial insurance differs from property or liability cover in several key ways. The loss is intangible. It's about lost profit or funds, not damaged objects. Claims require financial evidence like audited accounts or bank statements. Policies are often claims made rather than occurrence-based, meaning the loss must be discovered and reported within the policy period. Underwriting relies on accounting and forensic skills as much as actuarial data. These features make pecuniary lines one of the most analytical and data-driven parts of insurance. 7.7. The role of technology and data. With the rise of online transactions and digital payment systems, financial loss has taken new forms. Cyberattacks, ransomware, and social engineering have blurred the lines between traditional fidelity and cyber insurance. Modern insurers now integrate AI-driven fraud detection, real-time transaction monitoring, predictive modeling to identify abnormal behavior. Financial lines are evolving rapidly into digital-era products that protect the world's information economy. 7.8. Why financial and pecuniary insurance matters. Every economy relies on trust and cash flow. When that trust breaks, through fraud, bankruptcy, or disaster, pecuniary insurance keeps businesses operating and confidence intact. It's the invisible stabilizer that ensures contracts, investments, and commerce continue even under pressure. Without this class, industries would struggle to recover from the financial ripple effects of accidents, delays, or dishonesty. Now that we've explored how insurers protect money and financial continuity, we'll move to a rapidly growing frontier, emerging and specialized classes of insurance. These are the products of the modern world: cyber risk, political unrest, renewable energy, fine art, and event cancellation. NXT. We'll see how insurers adapt to tomorrow's challenges before they even arrive. 8. Emerging and specialized classes of insurance. Insurance has always evolved alongside civilization. Every time society invents something new, from the steam engine to the smartphone, new risks emerge that traditional insurance can't immediately cover. This constant cycle of innovation and adaptation has given rise to what we now call emerging and specialized classes of insurance. These are the modern frontiers of risk protection, where insurers design products for new technologies, changing political realities, and evolving lifestyles. 8.1. The nature of emerging risks. An emerging risk is one that didn't exist before or whose nature is still changing. Unlike established classes such as motor or property, emerging risks may not yet have reliable loss data, clear policy wording, or well-understood exposure patterns. Insurers must therefore rely on research, modeling, and cross-disciplinary expertise to create workable solutions. This is where the industry's creativity truly shows. 8.2. Cyber insurance. In a world run by data, cyber insurance has become one of the fastest-growing classes of business. It protects organizations and individuals from digital threats such as hacking, ransomware, and data theft. Core coverage areas: data breach costs, notification, legal expenses, and regulatory fines after a breach, ransomware and cyber extortion, payments demanded by hackers, including negotiation and restoration expenses, business interruption, loss of income following a system outage or cyber attack, third-party liability, claims from customers or partners affected by a data leak, reputational damage, PR and crisis management costs. Cyber insurance is complex because technology evolves faster than law or underwriting models. It now sits at the intersection of IT security, legal compliance, and financial recovery. 8.3. Political and credit risk. When companies operate internationally, they face risks that have nothing to do with fire or theft, but everything to do with politics. Political risk insurance protects businesses and investors from losses caused by government actions or instability, such as expropriation when a government seizes private assets, nationalization or contract cancellation, currency inability to move funds out of a country, political violence, civil war, or terrorism. Closely related is credit risk insurance, which protects lenders and exporters against non-payment due to political or economic events. Together, these policies make global trade and investment possible in volatile regions. 8.4. Contingency and event insurance. Events, from concerts and sports tournaments to exhibitions and festivals, involve massive planning and investment. Contingency insurance protects organizers from financial loss if an event is cancelled, postponed, or disrupted for reasons beyond their control. Typical causes include weather conditions, non-appearance of a key performer, equipment failure or venue damage, national mourning, strikes, or security issues. In a world still recovering from global pandemics, this class of insurance has gained new significance. Many policies now include infectious disease extensions, reflecting the lessons learned from COVID-19. 8.5. Fine art and specie insurance. Art and collectibles represent culture, heritage, and immense value, often irreplaceable. Fine art insurance covers paintings, sculptures, and rare artifacts against loss or damage, whether in transit, on display, or in storage. Closely related is specie insurance, which covers highly valuable portable items such as jewelry, precious metals, and cash in vaults or transit. These policies are often written for museums, galleries, and collectors, jewelers and auction houses. financial institutions storing bullion or currency. Underwriting depends on strict security standards, safes, alarms, escorts, and transportation protocols. 8.6. Renewable energy and environmental risks. As the world transitions toward clean energy, new exposures have appeared. Renewable energy insurance covers the construction, operation, and maintenance of wind farms onshore and offshore, solar power installations, hydroelectric and geothermal plants, hydrogen and carbon capture facilities. These projects face unique risks: mechanical failure, weather damage, power interruption, and supply chain delays. Insurers are also developing policies to support green finance and carbon credit trading, linking environmental goals to financial protection. 8.7. Drone and autonomous vehicle insurance. The rise of drones and self-driving vehicles has created entirely new categories of risk. These machines blur the line between aviation, technology, and liability insurance. Coverage areas include damage to the drone or autonomous vehicle, third-party injury or property damage, privacy and data protection claims, for example, unauthorized filming, malfunction or software errors. As regulation catches up, insurers are shaping the legal and operational framework for these technologies. 8.8. Space and satellite expansion. While we explored space insurance earlier, the sector is expanding rapidly as private companies enter orbit. New risks now include reusable rocket launches, satellite constellations for internet coverage, space debris and collision hazards, lunar and asteroid exploration projects. Emerging space insurers are blending aerospace engineering with complex financial modeling, insuring the most expensive machines humanity has ever built. 8.9. Reputation and intellectual property insurance. In the digital era, reputation is as valuable as capital. Reputation insurance helps businesses recover from public relations crises, misinformation campaigns, or sudden loss of brand trust. It may cover PR costs, loss of future income, and even shareholder claims. Meanwhile, intellectual property (IP) insurance protects patents, copyrights, and trademarks against infringement or legal disputes. This type of cover is vital for technology, pharmaceutical, and creative industries where innovation is the primary asset. 8.10. Parametric and index-based insurance. A revolutionary development in recent years is parametric insurance, which pays out automatically when a predefined trigger occurs without the need for a traditional claim investigation. For example, a crop insurance policy may pay when rainfall drops below a set threshold. A catastrophe policy may activate when an earthquake exceeds a certain magnitude. This model uses data and sensors to deliver instant payouts, making insurance faster, fairer, and more transparent. 8.11. Common themes across emerging classes. Despite their diversity, emerging classes share a few defining traits. Data-driven underwriting, relying on analytics, AI, and satellite monitoring. Global reach. Many risks transcend national borders. Regulatory uncertainty. Laws often lag behind innovation. Rapid evolution. Policies require constant updates to remain relevant. Collaboration. Insurers increasingly work with tech companies, engineers, and governments to design these products. Emerging risks demand creativity, adaptability, and a willingness to ensure the unknown. 8.12. Why emerging and specialized classes matter. These new lines of business demonstrate the real purpose of insurance, not just to repair the past, but to enable the future. They give entrepreneurs, scientists, and governments the confidence to innovate, knowing that if something goes wrong, recovery is possible. From cyber networks to clean energy to global events, emerging insurance classes protect the systems that define modern life. We've now explored nearly every major class of insurance: property, marine, motor, aviation, life, and financial lines, along with the cutting edge of innovation. But one crucial mechanism ties them all together: reinsurance. In Section 9, we'll see how insurers themselves manage risk by sharing it with other insurers, creating the global safety net that makes the entire industry possible. 9. Reinsurance and market integration. Every insurance company promises to pay claims when disaster strikes. But what happens when a catastrophe is so large that it threatens the insurer itself? That's where reinsurance comes in. Reinsurance is, quite simply, insurance for insurers. It allows them to share risk with other companies, stabilizing their finances and ensuring they can always meet policyholder obligations. Without it, no single insurer could survive the scale of global events such as hurricanes, earthquakes, or pandemics. 9.1. What is reinsurance? Reinsurance is a contractual agreement in which one insurance company, called the cedent or primary insurer, transfers part of its risk portfolio to another company, known as the reinsurer. In exchange, the cedent pays a portion of the premium. The purpose is not just to reduce exposure, but to protect against catastrophic losses, smooth out fluctuations in annual results, increase underwriting capacity, strengthen solvency and credit ratings. Reinsurance operates behind the scenes, invisible to the everyday policyholder, but it's what keeps the entire system functioning. 9.2. How reinsurance works. Imagine a primary insurer that covers 10,000 homes against flood damage. If a massive flood affects an entire region, claims could reach hundreds of millions. By ceding part of that exposure to a reinsurer, the company ensures it won't be wiped out by a single event. In practice, the cedent pays a reinsurance premium, and in return, the reinsurer agrees to reimburse a proportion of the claims according to the contract terms. 9.3. Types of reinsurance. Reinsurance arrangements can take several forms, depending on how risk is shared and triggered. 1. Facultative reinsurance. This is case-by-case reinsurance. Each policy or risk is individually offered to and accepted by the reinsurer. It's flexible and used for large, unique exposures, for example, a power plant, a bridge, or an airline fleet. 2. Treaty reinsurance covers a whole portfolio or class of business automatically. Instead of negotiating each policy, the reinsurer agrees to accept all risks of a specified type within certain limits. Treaty arrangements are long-term and efficient for both parties. 9.4. Proportional versus non-proportional structures. Reinsurance contracts are typically structured in one of two ways. Proportional pro rata reinsurance. The reinsurer takes a fixed share of every risk and every premium and pays the same proportion of every claim. For example, a 50% quota share means the reinsurer receives half the premium and covers half the losses. Common types. Quota share. Fixed percentage across all policies. Surplus share. The cedent retains small risks but cedes larger ones above a retention limit. Non-proportional excess of loss reinsurance. The reinsurer pays only when losses exceed a certain threshold, called the retention. It's like a high-level deductible for the insurer. Common types. Per risk excess of loss applies to individual large losses. Catastrophe excess of loss applies when a single event like an earthquake causes multiple claims. Stop loss protects the insurer's overall annual results from exceeding a set loss ratio. 9.5. Retrocession. Reinsurance for reinsurers. Even reinsurers need protection. When a reinsurer transfers part of its own portfolio to another company, the process is called retrocession, and the recipient is a retrocessionaire. This multi-layered system creates a global web of shared responsibility, distributing the impact of catastrophic events across many institutions. 9.6. How reinsurers support the market. Reinsurers do far more than share losses. They play a central role in the financial and technical health of the industry by providing underwriting expertise and data analytics, helping insurers model catastrophe exposure, advising on capital management and solvency, financing growth through reinsurance capacity. Many reinsurers also conduct deep research into natural catastrophes, climate change, and emerging risks, knowledge they share with the wider market. 9.7. The role of reinsurance in catastrophes. Large-scale disasters highlight why reinsurance is indispensable. Consider earthquakes in Japan and Turkey, hurricanes across the Caribbean or United States, European floods or wildfires, global pandemics affecting health and business interruption. When such events occur, billions in claims are spread across multiple reinsurers worldwide, preventing the collapse of any single insurer and maintaining public trust. Reinsurance effectively turns a global crisis into a manageable financial event. 9.8. Alternative risk transfer. In recent years, traditional reinsurance has been joined by alternative risk transfer methods that connect insurance to global capital markets. These include catastrophe bonds, cat bonds. Investors provide capital to cover catastrophic losses and earn interest unless a disaster triggers the payout. Industry loss warranties, ILWs. Payouts triggered when total industry losses exceed a certain level. Parametric reinsurance. Payments based on measurable events, for example, earthquake magnitude or wind speed, not on actual claims. ART solutions bring in investors such as pension funds, adding liquidity and resilience to the global insurance system. 9.9. Reinsurance accounting and claims flow. When a claim occurs, the primary insurer pays the policyholder. The insurer then submits a reinsurance recovery request. The reinsurer reimburses its share based on the contract's retention and limit. This process ensures policyholders are paid quickly, while reinsurers provide the financial support in the background. Modern reinsurance operations rely heavily on automation and global claims platforms to handle large volumes of complex data. 9.10. Global reinsurance hubs. Reinsurance is an international business concentrated in a few global centers, including Zurich and Geneva, Switzerland, Munich, Germany, Bermuda, Singapore, New York and Hartford, USA. These hubs host the world's leading reinsurers, brokers, and analytical firms, all working together to distribute global risk efficiently. 9.11. Benefits of reinsurance to insurers and society. Reinsurance strengthens the entire insurance ecosystem by protecting solvency and ensuring claim payments, encouraging innovation through risk sharing, reducing price volatility for consumers, allowing insurers to write more policies and support economic growth. At a societal level, it provides the financial stability that helps communities rebuild after catastrophes. 9.12. The future of reinsurance. The future of reinsurance lies in technology, data, and climate awareness. Reinsurers are increasingly using AI and predictive analytics to model losses, climate modeling to anticipate new patterns of catastrophe risk, blockchain for transparent contract management. As the world faces more frequent natural disasters and interconnected risks, reinsurance will remain the backbone of global risk management. 9.13. Course summary and closing. We've now traveled through every major branch of the insurance world, from property and liability to life, marine, aviation, and beyond. Each class of business serves a different purpose, but all share one mission: to protect society from the financial impact of loss. Insurance transforms uncertainty into opportunity. Reinsurance ensures that transformation remains sustainable. Together, they create a resilient global system that enables progress, innovation, and recovery, the silent infrastructure that supports every modern economy. Thanks for watching. Like and subscribe.